Let me start with what's happened overnight. Meltdown is the only way to describe what we've seen in the US markets overnight, as recession fears are back and they've gripped the street. The Dow plunged nearly 900 points overnight. You've had the Nasdaq down 700 points, 4% in a painful session of trade. Look at the futures. I want to pull up Dow futures just for a second at least and see where we're going after that huge hit on US markets. I mean, we can't take much heart from that, 55 points in the green. Treasury yields have also slid as recession fears grow, the 10-year at 4.16. Crude has slumped on tariff fears. Brent is below $69 a barrel. I mean, you would think all said and done, cheaper crude, yields coming off, good for India, but the reasons is what's worrying, which is why you're going to see a negative on the implied open as far as India is concerned as well. So now the question is, what are these recession fears that seem to have come in the last 48 hours and where are they coming from? So let me break that down for you. First, what the White House has said on the market crash, because there was actually a statement coming in. And the statement from the White House is, we're seeing a strong divergence between animal spirits of the stock market and what we're actually seeing unfold from business and business leaders. Let me break that down to you for what it actually means. It's essentially that what the stock markets are doing is reactive, but it's going to be good for business. The start of all of this is an interview by US President Trump to Fox News, where he was asked specifically, do you think there's going to be a recession? And he says, I hate to predict things like that. There is a period of transition because of what we're doing is very big. Now, that's a statement that has sparked off all the fears. And we told you about this in yesterday's show as well at the same time, that this statement that we're going through a period of transition is something that the street is not liking. It was actually echoed in a way by something that the Treasury Secretary, Scott Bessent, also said. And he described it as a detox. He says the market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period. Now, call it a transition, call it a detox, call it panic, what you will. The screen is only showing pain at this point, and which is why you're seeing what you're seeing on the screen. I want to pull up Asia before we get to our first speaker today and just show you what the Asian markets have started off with. I mean, no surprises there. Shanghai relatively doing okay, Nikkei in pain, Hang Seng about 0.5% down, implied open. Once again, we're about 120 points off. Okay, 100 points down right now in what the Nifty seems to open at or could open at. Sonal Verma, first conversation this morning, Managing Director and Chief Economist, India and Asia ex-Japan at Nomura, with us this morning. Sonal, pleasure as always to speak with you, and thank you so much. I think great time to get your perspective with everything happening. As the Trump trade seems to be receding quickly and maybe disappearing, what does this mean for emerging markets, especially India?
Well, it's an extremely tough period because if the US does go ahead and implement the various tariffs that it's promising to on 2nd of April, which is something as a house we think is likely to get implemented, then from an economic perspective for the US, we are likely to see weakness in growth. We think it's going to be a year of below trend growth and higher inflation as the tariffs kick in. So that stagflationary kind of a backdrop actually ties the Fed's hands in terms of what they can do. And as you all were discussing, the US administration is also ready to take some short-term pain for what they believe is going to be a medium-term benefit for the US economy. For EMs in that backdrop is essentially much weaker growth. We think disinflation is likely to still happen because higher tariffs on China does mean the risk of more dumping of those excess products in other countries. But then we also need to basically be ready for more volatility in terms of financial markets, in terms of more capital outflows, currency spillovers, which typically do have feedback loop back into consumers through the wealth effect and businesses because of uncertainty. So essentially, weak growth and more volatility is what it all means.